So, Mike, one of the things I like about our conversations here is that usually it veers towards the more practical and the less abstract. I mean, I often abstractify things.
Yeah.
I'll talk about things at the higher level, but you bring it down to earth. And so I thought we would just start the conversation that way. What is a practical tip that comes from your years of seeing those that are more successful and those that didn't quite make it in the real estate game? Like, what's one specific thing that you see the successful people doing?
Well, let's look at success from our side, which is the money side. Money is a key factor in real estate because it's a high leverage, meaning people borrow a lot of money to build these portfolios.
Mm-hmm.
So one of the tricks that I've seen that helps people accelerate, take advantage of more things, is how they take care of their leverage on certain properties or on their portfolio. And this happens if you have 2 properties or 10 properties. How do you create something that gives you a leverage over everyone else? And part of that is picking one property and focusing on paying that down as much as you can or all the way down, because you're freeing up equity in one property compared to multiple. And here's where the benefit is. If you're looking to get a line of credit, if you're looking to get other monies for other deals that pop up, we see so many of these people who are successful, who are doing business, and they get to the point where deals just come to them, and the successful ones can take those properties that come to them and close them on a dollar amount that they dictate. And that only happens when you have free cash flow or when you have the money to do whatever you want. And I'm not talking about money in their pocket. I'm just talking about leverage. So they have one property that's, let's just call it completely paid off or paid down to lower loan to value, where I could get a HELOC on that property and never use a HELOC for anything but taking advantage of these great deals that just come up, auctions, someone needs to sell, some other investors in trouble. The really good people who grow their wealth just sit back and grab these things up, and they can do that because they have money available when they need it to target these properties.
Okay. So I have questions about this. First, I wanted to say subscribe, like. There's a lot more content on the channel like this. So back to what we're talking about here. I have a question about how this all kind of ties together. So I heard you say that the successful people, they have the cash flow, so they can go out and get the right loan. They kind of are educated. They figure out if they need a HELOC or a different kind of loan. But the thing you said first was this idea about paying off a loan.
Yep.
Is that the key here? Is like paying off one at a time instead of trying to divert, like really focus on one?
Let's just say you have 5 properties
Uh-huh.
and they're all at 75% loan to value, which frees up in the world of leverage, of world of money, really does not free up any of that equity for you to use for anything else. We have so many investors that are just like, I have all this equity, but I can't do anything with it. Mm-hmm. And the reason they can't do anything with it is they keep paying them all down equally.
Right.
So
remind me what the 75% loan to value would look like.
So let's just say you have a $200,000 property,
okay,
and you have a loan on it. So you have a loan for $150,000.
So the loan is 150. The value you have
it's 200, and they're like, I have 50 grand here. I have 50 grand on 5 properties, so I have 250,000. I have a deal that's coming up. I could buy for 150, but I can't use any of this equity because no lender will lend over 75% cash out on an investment property. So they've kind of boxed themselves in.
So if you pay off one of those properties and you get a lower loan to value, is that right?
Yeah.
Or is it lower or higher that you're looking for?
You're looking at a lower loan to value on that property.
Is a good thing.
So you can open things up because
Gotcha.
You can get HELOCs up to 70 and sometimes 75% of the LTV on a property, but you have to be at a lower loan to value then. So let's say we have these 5 properties and we're paying them down and we have a little extra money and we just pay an extra $100 each on these properties, all of them going down. It's going to take years to free up the equity.
Yeah.
Instead of concentrating that $500, let's say, on one loan. So it goes down faster. It goes down to a number. Maybe it's 100% paid off. So at any time that one of these opportunities come up, they could use that property as leverage to buy what they need. Mm-hmm. Typically what the smart people do is they pay them down to where they can at least get a HELOC, 50 to 100 grand HELOC for when things come up, and they could snap at investments that pop up that just make great sense because they always come at unopportune times when you get a great deal. Once a week, at least, we talk to people who are like, I had the opportunity, I just was in something else and I couldn't do it. And they're like, I have all of this equity in all these properties combined, but in each property, lenders look at it like you're maxed out leverage. So if I took my 5 properties and concentrated on one, getting it down to maybe 50%, maybe getting it down to, like in this example, we have a $200,000 property. If I got it down to 50% LTV, which is a loan for $100,000, I free up about $50,000 that I could use for a HELOC, which maybe is all I need for a down payment or to buy that property. You pay it all the way down and you get a line of credit on that. Something pops up at auction. You just write a check and go get it. Some deal just dropped. Someone did not close like they were supposed to. I could write a check and get it for the price I want. With HELOCs and stuff like that, you don't pay for the money unless you use it. But having a portfolio where you have at least one property that is paid down or paid off gives you the flexibility to take advantage of these things that get you into the 50 and 60% equity buys, meaning you're buying something at 40 or 50% profit. And that's where I see, because they pick up maybe one a year, maybe even one every 2 years. But if you do that, and it's just like someone handing you $100,000 or $200,000, that's where they accelerate above everyone else, because they have the flexibility, they have the money available. When these things pop up, they write a check, they close it, and bingo, bango, their wealth and income goes right up.
I see. So the thing that successful people are doing is they're not spreading their money out over, when they have extra, they're not spreading it out to pay off all of their loans a little bit. They're focusing on one, paying it down, and that gives them the leverage to get a HELOC should an opportunity arise. If it's a good investment opportunity, suddenly they have that ability because their loan to value is lower on at least one of those properties, and so they can get a HELOC on that.
Yeah. If they got that thing down to zero, even if they're not in the market and they're just watching it, they can still pick up a great property and flip it to someone else and make an extra 20, 30, 40, 50 grand, even if they don't want it. The people who have cash available, even if it's just not cash, it's just a line of credit on a house, they're the ones who accelerate because they get those great deals once a year, twice a year, that someone needs to close in a week or a couple days, and the value's there. They take advantage of it. So concentrate your efforts on paying down one, even if you only have 2 properties and you have some extra money, concentrate on paying down one to at least free it up so you have a little more equity in it, where the lenders will come and give you a line of credit, a HELOC, give you the flexibility to use that to buy properties, put money down on properties, whatever it is. Use your equity to your advantage as a real estate investor, that you can write a check, get what you need, and not have to go through a lender every time and not pay the points and all the costs. I'm a lender, but to me, it's just one of the smart ways that people excel.
Yeah, using equity to your advantage. I like that.
Yep.
So if someone wants to learn more, they've already subscribed to the channel and they want to, reach out to you, is that a thing they can do?
Yeah, just go to our site, thecashflowcompany.com. We have a quick inquiry, or just email me at mike@thecashflowcompany.com. We respond to everyone, typically within one business day. We look at scenarios. Even if we can't do it, we can typically tell you who can.
Fantastic. Okay, so thecashflowcompany.com, mike@thecashflowcompany.com. Don't forget to subscribe, everybody, and thanks for the chat,
Thanks.
Mike.
Appreciate it.
Wow.